Hello, Ed Yardeni here. My voice is still a bit raspy from the COVID that I managed to get over a week ago, but I've gotten over it. Tested negative Sunday a week ago, Sunday morning, and then we got on a plane to St. Martin for a family vacation down there. I felt all right, except there's a lot of coughing. When I got back home, my doctor put me on a steroid, and that immediately caused a hiccup problem, which I think I've overcome. So I hope I can get through this without any problems. I did have a problem this morning when I first recorded this call. For some reason, the charts wouldn't show up. I think I solved that problem, so I'm re-recording it and giving you sort of a quicker, shorter version update of what I did live Monday morning. So without further ado, let's go look at not just the charts for this morning, but also from a week ago, Monday, when we wrote a piece right before we took off for Thanksgiving, and that piece focused on Thanksgiving and things that we're thankful for, and we're certainly thankful for the fact that many of you have been longtime supporters of our service. Let's go and share some charts here. Hopefully, I think I figured out how to confirm. Yep, we're good. So, I guess what I'm thankful for is that the economy continues to be remarkably resilient in the face of this extraordinary tightening of monetary policy that we've had really since March of this year. For March of this year, we're basically up over 400 basis points on the two-year Treasury note. Mortgage yields have doubled to about 7%. And yet the economy is still growing. Didn't look like that in the first half of the year when it was down slightly for real GDP in the first and second quarters. And some pessimists got excited that that was at least a technical recession and could become something worse. But instead, we've seen that real GDP actually increased solidly in the third quarter and continues to do so in the fourth quarter, led by consumer spending, which is obviously the heart of our economy in terms of the magnitude of the consumer. Let's have a look at what's keeping the consumers going. Let's look at the housing market. Let's look at some indicators of capital spending and see what's going on here. I think what they all add up to is an economy that is developed some resilience to a very tight monetary policy, and it is more likely to experience a soft landing than a hard landing, in our opinion. That's still our opinion. So consumers, we know have a lot of excess savings. They managed to stash away some piles of savings since the pandemic. They didn't spend all of those checks that were provided by the government during the lockdowns. They'd saved some money, and as the lockdowns ended, they went ahead and spent some money on goods and services, particularly goods, because it was hard to buy services following the lockdowns. But as you can see from this chart here, the personal savings rate has come down pretty dramatically, and that's allowed consumers to spend more of their disposable income, less in savings, more in consumption. And that's largely because they had this 24-month sum pile of personal saving. And that's starting to come down. But by some estimates, or at least $1 trillion, maybe as much as $2 trillion in excess savings still left over for the consumer. So that's keeping them going. But more fundamentally, they're doing well because the labor market's tight. And you can see payroll employment is at an all-time record high. It's hard to talk about a hard landing when this is continuing to rise to a new record high. And this is one of the four components of the index of leading economic indicators. So that looks pretty good. It's one of the four components of the index of coincident economic indicators. This is just several measures of wages and salaries in personal income. And you can see that in current dollars, our earned income proxy is at an all-time record high. Adjusted for inflation through September, it's at a record high, though obviously inflation has eroded some of the quite a bit of the purchasing power of increases in nominal earned income. Some skeptics say, well, it's all because consumers are borrowing money to keep their spending going. Again, I don't think that's the only story there. The excess savings there, the payroll employment gains are there. And what's the point? I mean, if consumers are borrowing, they're borrowing. And that is, in fact, boosting consumer spending. It's when they start to lose jobs or fear that they're going to lose jobs that consumers start to cut back on their revolving credit. Right now, for all the concerns about consumer confidence being very depressed, that doesn't jibe with the fact that consumers seem to be confident enough to charge things on their credit cards. This is the consumer sentiment index, very depressed. I've often observed, half in jest, that American consumers are wonderful. When we're happy, we spend money. When we're depressed, we spend even more money if we have the access to that kind of purchasing power. And as I just reviewed, the purchasing power is there. And even though consumers' mood is very sour, they're definitely spending money. We saw that in retail sales numbers for October. They were up a bit. Inflation adjusted, they're kind of going sideways, but they're still above their trend prior to the pandemic. But sideways is okay when you factor in that while consumers have pivoted from goods, they've pivoted to services. So we see a lot of spending in services. Housing, that looks terrible, right? The mortgage rates have soared, affordability has collapsed, and single-family housing starts, the blue line in this chart's taken a dive. I mean, it's nowhere near the kind of calamity we had back here during the great financial crisis, but it is coming down. But the offset is we got some strength here in multifamily construction. And that's kind of important because multifamily construction now accounts for something like half of total residential private construction. So we know that rents are high. We know that landlords and the developers and landlords have an incentive to build more rental apartments. And that's exactly what's happening. And it's offsetting some of the weakness in single family houses, which is attributable to the collapse in affordability. We've seen mortgage rates go up at the same time that home prices haven't really come down much. And that's because there's a real shortage of inventory of both new and existing homes. Let's skip that. So when we look at some of these industrial production indicators that came out last week, they look pretty good. Not great, but they look pretty good, not terrible for some key sectors of our economy, particularly capital spending. First, let's look at the overall index, kind of flat, includes utilities and mining. The manufacturing index is up a touch. Leading the way there has been actually auto production, which is pretty impressive because, again, in typical business cycles, interest rates go up. Let me turn that off. So I never remember to do everything I'm supposed to in preparation for these things. So the motor vehicle production is up, which is impressive because during recessions, typically motor vehicle production goes down because credit conditions have gotten so much tighter. Let me just take this person out of their misery. Okay. So this time around, we're getting production actually going up because there is so much pent-up demand that for over a year now, we've had part shortages. And so there's a lot of pent-up demand. And that's another reason to believe that some of the weakness in the auto industry related to tighter credit conditions will be offset by the tremendous amount of still pent-up demand that might at least allow upper income people to buy cars that they hadn't been able to get for a while. Let's look at some of the industrial production of business equipment indicators as a sort of a monthly way to follow capital spending. Looks pretty good, actually. Total is here. It's not at an all-time record high, but it's still on an upward trend. Look at transit. That looks pretty good. There's some pretty good strength in demand for trucks, heavy duty trucks. Information processing, again, this is all business equipment. Look at information processing. That's the green line, all-time record high. And industrial equipment, not at an all-time record high, but certainly continuing to go up. I think that's consistent with onshoring and some of these infrastructure spending bills and semiconductors bills that the administration has passed. So there's a lot of strength, I'm saying, in capital spending. Look at technology. The stocks have been terrible. But look at computers, the production of computers and peripherals, all-time record high. What's that all about? Well, it's certainly not PCs for consumers. They bought them during the pandemic. But apparently it's servers and other enterprise computers. So that's still very strong. Look at this, communications equipment, all-time record high. Semiconductors is weak, but still in a solid upward trend. I'm not particularly concerned about that since semiconductors just go into just about everything these days. So all in all, this looks pretty good. And then, of course, production of defense and space is all-time record high. With the war in Ukraine, we're obviously working on replenishing munitions for the Ukrainians. And because the world's become an even less safe place, and it's been quite some time with geopolitical tensions with China and Russia, this sector will continue to be very strong. Another strong sector is aerospace and transportation equipment. That's doing extremely well. The airports were mobbed during Thanksgiving. We need more planes. This is the index of coincident economic indicators. It's also consistent with the economy growing, and maybe a soft landing. Right now, it's hard to say the economy's landing at all. While a lot of us are debating soft versus hard landing, economy is still looking pretty good. The Atlanta Fed's measure is like over 4% for the fourth quarter. And a lot of that's because of consumer spending. So this CEI is highly correlated with real GDP, which looks like it's still growing. If you want to worry about something, it's the index of leading economic indicators, which peaked February of last year and is down through October. It's got a very good record of anticipating recessions. We're fighting it for all the reasons that I just went through. I guess you can find recessionary numbers out there. I think we're going to see one on Thursday in the national MPMI, Manufacturers Purchasing Managers Index. That looks like it got down to 50.2. It looks like it's going to go down to below that because of what we know from the regional surveys. Also, this week, we got some data on, earlier this week, we got some data on the MPMI flash estimate that S&P Global puts out, and that also confirmed that we're probably down under 50. Question is whether we'll see that for national, for the non-manufacturing. I don't think that's going to drop under 50, though the flash number fell under 50, but it hasn't been a very good indicator of the official number. Meanwhile, a lot of our inflation initially was transitory. It was based on supply chain issues, which have moderated and reversed really quite dramatically here. So that's going to give us some relief in inflationary pressures, particularly in the goods sector, not services. The rest you can look at on your own. It's just, maybe let's have a quick look, as we just had Thanksgiving, and we should be thankful for the fact that notwithstanding the challenges that the energy sector faces in the U.S. and around the world, in the U.S. we're producing almost at a record high. This is all the components that go into total production, and you can see biofuels, natural gas, crude oil field. This is what people usually monitor, is the weekly crude oil field data down here, and it doesn't look like it's doing very, it's certainly still below where it was before the pandemic. But again, there's natural gas liquids, biofuels, and put them all together, and you've got a near record high in production in the U.S., talking about 20.2 million barrels per day. We can look at the similar kind of thing with weekly data, and you can see product supplied is actually a measure of demand, and that's been around 20.9, and the imputed production that we get on a weekly basis is 22.7. We have this data and we have this data, so we can impute what production is. So production all-time record high, 22.7 through the week of November 11th, with net imports being negative. In other words, we're a net exporter of oil. And now, even more impressive was what's happening on the gas side. This is our consumption of gas, our production of gas, and net imports on a monthly basis. The latest we have is August. This is even more impressive. This is actual, not smooth 12-month, but actual data of imports of natural gas and exports of natural gas. And you can see that we've certainly seeing exports soar, and we're helping Europeans increase their storage of natural gas going into the winter, now that they've got this terrible problem with availability of Russian gas. They basically have to shut it off because of the tension with Russia. Let's go here. Yep, that's today's morning briefing, and the kind of a related follow-up. The Treasury yield curve, we're fighting that. That's been a good indicator of coming recessions. But I think what it's really been good at is predicting that if the Fed continues to tighten, then that'll cause a financial crisis, which will lead to an economy-wide credit crunch, which then would cause a recession. There's no credit crunch so far. There's financial crisis. Cryptocurrency markets are blowing up. The ARK meme and SPAC stocks have all blown up. And yet the banking system remains solid. The junk bond market really isn't blowing up. So all in all, I think this is really more of an indication that the bond market's telling us that rates are pretty close to peaking. I think the 10-year probably peaked at 4.25% on October 24th. And you can see this chart, which is just, this is the spread. These are the two yields. And it's very interesting to see that consistently coming, towards during booms, inflationary booms, just before recessions, the 2-year note rises faster than the 10-year note, and sometimes it exceeds the 10-year note, which is when you get those inversions. So, but that usually is when they kind of coincide. That's when you see the peak in rates, and I think that's what we're getting here, which is kind of a bittersweet picture for the stock market, because it suggests that the valuation multiple may not take a dive any further. But on the other hand, we're probably looking at a weaker outlook for earnings for a while. This is the trade-weighted dollar, which is also starting to confirm that the Fed's monetary policy tightening cycle is close to an end. And this is what I mentioned about the stock market. This is our Blue Angels analysis showing the S&P 500, the red line, versus these Blue Angels, which show forward earnings times multiples of 10 to 24 in increments of 2. And here you can see that the forward PE is around 17.5. Some people aren't happy about that, because in bear markets, we should at least get something good out of it. And usually you get much lower valuation multiples, making the market a screaming buy. And that's not the situation we have here. And so the PE is holding up because of thinking that the Fed policy cycle, tightening cycle, is getting near an end. But meanwhile, look at forward earnings. They're kind of rolling over. I don't think we're going to get something like what we get in a typical recession. It'll probably be more like a mid-cycle slowdown, kind of like what we had here, or kind of here. So more of a mid-cycle slowdown or a growth recession. Meanwhile, as I said before, the Supply chain indicators. This is the Federal Reserve Bank in New York. Supply chain indicators are looking like things are really easing off on the inflation front when it comes to supply chain issues. Indeed, this is the business surveys, unfilled orders, delivery times. And while this looks like it's kind of coming back to historical norms, this is obviously below historical norms. So supply chain issues are deflationary now instead of inflationary. Services, however, is where we continue to have a problem. This is a bunch of charts here from the regional surveys. We have 4 out of 5 through November, and they all continue to head downwards, but November did see some minor little upticks. So it's not a clean story yet on the inflation front. What is clean is our thesis that the consumer goods inflation rate would moderate pretty dramatically. And we see that in consumer goods CPI. We see that in consumer durable goods straight up. Now I think it's going to come straight down. And this is where we should get a lot of our improvement, is that this used to be negative inflation, deflation. And I think that's where there's no reason why it couldn't come back and have that kind of pattern again. Consumer non-durables is food and energy, they're commodities. High commodity prices typically are the best cure for high commodity prices. So that should help. Services is where the problems lie. We know that the CPI, turn that off again. We know that the CPI for primary residence has gone up to 7.5, but the Zillow index went up to like 17, and that's more reflective of current leases. This reflects all leases of the past, that's a year or 2 years. And it may be about middle of next year before we start to see the CPI residents start to roll over. So that's where we continue to have our problems. I mentioned the MPMI and the NMPMI. We have, make that a little smaller so you can see it. In this case, the S&P Global Flash is below, indicates that we're going to have a reading below 50 for the official number. And I think that's believable, supported by the regional business survey data. And here we have the NMPMI, which has not been as useful at predicting the actual. So I don't get too concerned about that. And let's face it, you would expect that the MPMI would be weaker than the NMPMI simply because consumers, as you can see from real GDP, consumer spending on services and goods, services are still on an upward trend because they're on a flat trend, as we discussed earlier. Finally, we did have an increase in new home sales in November. We did have an increase in new home sales in November, and that was probably an exaggeration because there's some data series showing that something like 25% of these sales are being canceled. And I think a more useful measure is these traffic of prospective home buyers, which remains very depressed, and it's down to lockdown levels when nobody went out to look at houses. So that covers a lot. I'm pretty sure that this time around I got the charts on deck to show them. Have a really good week, and let's do this again next week. With that, I'll say goodbye.